Good afternoon, everyone. I think by now people will start flowing into this webinar, which is actually the fourth edition already of our Latin American Policy Dialogues series, where we invite prominent speakers from Latin America, both policymakers and researchers, to share their views about the region and the challenges that they see ahead. And today we have the pleasure to have Alejandro Werner. He's the founding director of the Georgetown Americas Institute, which is a relatively new institution. And Alejandro has had a very distinguished career at the IMF, for over 10 years, leading the Western Hemisphere department. And today, Alejandro, he's going to give us his views about the economic performance of the region for this year and the challenges that he sees in terms of the economic recovery. And this will be followed by a discussion. You are all welcome to post your questions on the chat, and I will ask them after Alejandro's intervention. And well, I think we are all looking very much forward to hear Alejandro's views, because given the very troubled international environment that we are living through, of course, Latin America is not unaffected by all these different shocks. So it will be super interesting to hear from him what he sees in terms of the main challenges. Alejandro, the floor is yours, and thanks so much again for being with us today.
No, thanks, Aida, for the invitation. I'm really glad to be here with you. I think the last time maybe we had a similar meeting where was many years ago. I mean, there in Paris, we were there with a team of colleagues from the IMF, and we had a very fruitful and interesting discussion with the OECD staff on Latin American challenges. So I'm glad to rejoin this conversation at such an interesting and challenging time, as you were saying. No, first, we have a global economy that is going through, it was expected to go through a normal slowdown, and quote unquote normal, after the important rebound and recovery post the COVID recession, on the back of normalization of economic activity, withdrawal of fiscal and monetary stimulus, etc. And then first, we had the initial phases of the inflationary cycle, basically led by three main factors. One is obviously a US economy that was quickly, let's say last year, moving towards overheating territory on the back of a very good post-COVID-19 recovery, but basically held by significant stimulus, both fiscal and monetary, and obviously those that claim that the last stimulus packages were significantly larger than what the economy needed. Exposed ended being correct. However, you can also claim that under the uncertainty, I mean, maybe paying this inflationary price, it's a price worth paying given the risk that we were facing 18 months ago, and maybe it was good to overdo it, given the uncertainty that we did not know if the virus was going to take a more dangerous turn, et cetera, et cetera. But very clearly, I mean, the people that said, given the baseline, the stimulus was too large, given the size of the output gap and the way the US economy was recovering, were right. So you have, from the demand side, significant and strong currents towards overheating. Then you have negative supply shocks coming from commodities and from global value chains. And then you have obviously the effect of more recently of the war and the invasion of Ukraine by Russia, working through mainly commodity prices, and obviously Europe being the part of the world mostly affected. And I mean, by now it seems that everybody is in the camp that in the next 12 to 18 months, the US will go through a recession that, I mean, on the back of a pretty stretched labor market with significant losses in the purchasing power of wages in the last 12 months. Obviously, workers will try to recuperate the real value of wages given the tightness of the labor market, and the only way to cool this down is basically by putting the US through, let's say, a mild recession that with some luck, there are no pocket of financial vulnerabilities, etc. So this will not trigger more daunting problems. But basically, I think now we're getting into a recessionary baseline with maybe inflation that continues for a significant period of time, and maybe depending on how these things play out and depending on how the excess savings by the households are used, might need more surprises coming from the Fed. Then we have a Chinese economy that obviously has gone through significant and unexpected lockdowns during unexpected, let's say, if we put ourselves in October of last year. I think at the beginning of this year, a lot of people were signaling towards the zero COVID policy in China as a big risk, and it has materialized, and obviously that continues to delay the full recovery of global value chains. And obviously that's another negative factor for the recovery in the world economy. Turning to LATAM, that, I mean, it's the theme of today. I would like to highlight a couple of things at the beginning. First, 2020, maybe it's too late, sorry, 2021, maybe it's too late in 2022 to talk about what happened in the previous year, but I think it's important to notice that Latin America was the region in 2021 that had the largest positive growth surprise. I mean, if you look at yours and IMF, et cetera, forecasts at the end of 2020, beginning of 2021, and then you compare the actual growth outcome to the expectation, LATAM suffered the largest positive growth surprise. I think that also tells us a lot about how we forecasters tend to have a negative bias vis-a-vis growth in Latin America, especially during this COVID cycle, no? Given the lackluster growth that Latin America has had in the last 2-3 decades, no? So in that sense, that I think this positive surprise is explained by at least 4 factors. One, it's a world recovery that was stronger than what we expected. But I think also last year, the withdrawal of the fiscal stimulus was much smaller than what we thought. When we started 2021, we thought that, I mean, Latin America in 2020 had a much larger space to do fiscal stimulus than what we all thought. But obviously that 21 was going to be the year in which this should be withdrawn. On the back of Delta and Omicron, there was more uncertainty on how the economy was going to do. At least the first delays in vaccination, let's say in the first half of the year, also, I think, push governments to be cautious on the withdrawal on fiscal stimulus, and markets continue to be there to support the funding of these larger than expected deficits, smaller than in 2020, but still larger than expected. So I think that the smaller fiscal withdrawal is one, and the same thing, I would place it mostly on fiscal. Secondly, I think the vaccination campaigns, especially in the second half of 2021, were much better than expected. I think if you look at the large LATAM economies, Brazil, Mexico, Colombia, after a slow start, given especially the availability of vaccines, But given the tradition that these countries have in relation to national vaccine campaigns, etc., once that the availability problem was kind of, I wouldn't say solved, but managed, they were able to deploy the vaccines pretty quickly. And you reached vaccination rates with a combination of, let's say, the European and US vaccine together with Russian and Chinese that were in the levels of 65%. I mean, obviously Chile, 80%, et cetera, that adjusted for the demographics of Latin America were pretty comparable or even better than what we were seeing in the advanced economies, especially by the end of the year, without any problems with terms of vaccine hesitancy and those cultural issues that had affected some advanced economies. And then, yeah, the service sector recovered, I think, better than what we expected last year. Then the bad news is that none of the forecasters kind of basically they assumed that 100% of the positive surprise in 2021 was transitory. In a sense, nobody took that shock as signaling that maybe our models were maybe underestimating the level of potential GDP in Latin America, et cetera. Well, maybe the level, yes, but not the growth rate. We basically said this is a one-off, but we're not, this does not tell us that the recovery going forward is going to be faster and it's going to continue. Basically, we're going back to potential GDP. We accelerated the recovery, but in 2022, we're going back to the 2.5%. And that obviously implies a scarring effect of around 4 to 5% of 5% in Latin America. So permanently, vis-a-vis pre-COVID forecast, we are going to be 4% below what we expected at the end of 2019. And I think that's an aspect that maybe I would like to highlight at the end of my initial remarks, that maybe we as economists have to look a little bit deeper into it. I think, at least when I was at the fund, and I think this tends to continue, we haven't done a deep dive analysis trying to understand really where are these scars coming from in terms of the destruction of matches between labor and capital, maybe in the medium term. I mean, the schooling that we lost, that's going to have permanent effects, et cetera, et cetera. But I think this needs a deeper economic analysis, getting into microeconomic data, try to analyze what proportion and what type of firms were destroyed and disappeared during the pandemic. Are they coming back? Are they not coming back? Are they coming back in a better shape, in a different shape, et cetera, et cetera? We do know that although the important labor market recovery that we had, again, was pretty impressive, wages were lower than the wages of workers coming back to the workforce were significantly lower than the ones they had before the pandemic. And obviously this reflects maybe a lower quality of matches, et cetera, but maybe those matches will ramp up and on-the-job training will put them back in terms of productivity to where they were before the pandemic. So I think all of that deserves, from the medium-term perspective and where we're going to settle after all the noise of the post-pandemic business cycle is over. I think it deserves more study. But at the end of the day, I think we all kind of assume that Latin America is almost back to the new potential GDP in 2022. And from then on, it's kind of on average 2.5%. And on top of that, now we did assume that in 2022, the fiscal withdrawal will be complete or almost complete, and the normalization of monetary policy and political uncertainty associated to elections in Colombia and Brazil was going to really contain economic growth. Also in Chile, I mean, Chile having gone through, let's say, the largest aggregate demand experiment in emerging markets, both from the fiscal side and the quasi-fiscal side, from the pension withdrawals, we really said, well, Chile is going to go from 11 to almost 0, no? Because all of this is going to be gone. On top of that, we have the Constitutional Assembly plus the new president, etc. And maybe, I mean, some positive surprises are coming from growth in those in those years. Then putting all of these in a medium-term concept, I mean, Latin America has been the region with the worst growth performance since, let's say, 2010. Between 2015 and expected 2025, hardly we're going to see any growth in GDP per capita. Social tensions have been plaguing the region, let's say, from 2014, where we have significant demonstrations in Brazil on the back of discontent on the quality of public services. So we have this mixture of mix of significant social and economic gaps that have been building. On the one hand, the economic gap, I mean, a very lackluster GDP performance that doesn't point towards any kind of convergence on average for the region in the future. Let's say another lost decade in terms of GDP per capita, and also significantly biased towards the weaker segments of the population, especially after the pandemic, where low human capital households, women, youth, etc., are the most affected in terms of labor market dynamics after the pandemic. So this creates significant social discontent that I think it's also explained by, let's say, this dynamic of a growing middle class that now see the risk of potential backsliding back to poverty. And also it's in a position to be more critical of the socio-political equilibrium that these societies are going through, especially in these young democracies. No? So when you go even outside the realm of economic indicators, and you look at how the judicial system works for 70% of the population. And I'm pretty sure, I mean, you have a significant rejection and perception of the judicial system being biased towards, I mean, serving the top 1% of the population, and then providing a pretty unfair and inefficient service to the rest of the population. Not a lot, and it has not been present explicitly in government's agenda, the issue of a strong antitrust policies. When you look at, for example, the significant effects on income distribution of the large levels of concentration that we might have in Latin America in retail, in foodstuff, etc., then, I mean, that's another very important area in which, I mean, there's a significant bias against the top 50% of the population in terms of the cost of their consumption basket, that it's not being addressed. Security issues as well. So I think there's even there's some racial issues that I think in Latin America we have minimized, that are also part of this sense, let's say, of lack of legitimacy of the system that in a stagnant economy becomes even worse. So obviously, as many people have said, I mean, there's a need, especially in countries like Peru, Colombia, Mexico, et cetera, that have a low level of government protection of, let's say, a new social contract with higher public sector income allocated to education, health, and the state becoming more responsible in terms of providing social insurance to the population, and obviously better quality education and better quality of services. This has come hand in hand with a situation that, I mean, has happened all over the world, but maybe ex ante one would have expected that a crisis triggered by a health emergency, a virus coming from outside, maybe was a shock that would have been used to reduce polarization. But I mean, maybe that was completely mistaken, exposed almost everywhere. This was a shock that actually contributed increase polarization and increase tensions. And all of this now in an environment in which we have a big fiscal challenge because debt has gone up. Still, we need to consolidate public finances. Interest rates are going up faster than what we thought. We will have let's say, the positive one-off of unexpected inflation eroding a little bit of the debt, maybe for a year and a half, and that will help us. But after that, the shock on interest rate will start feeding first into short-term debt, then into longer-term debt when we start renewing that debt, and then the full effects of the higher interest rate will start to be felt in debt dynamics. No? And now we are facing obviously this inflationary shock that, again, at least has three causes. One is the normalization of economic activity in Latin America happening faster than what we expected, especially in those countries that put in place significant fiscal stimulus. And I think they're the most important example of this group of countries is Chile, in which, I mean, even the central bank, et cetera, it has pointed towards already a positive output gap. And that meant that the normalization of interest rates from 0 to neutral should happen much faster than what we thought. So central banks started picking up. Then the second effect is obviously the imported inflation. And then you would say, look, I mean, as any textbook will tell you, you would like to look through this shock unless you start getting concerned about secondary effects and persistent in price setting mechanism and wages of this transitory shock in the economy. And given at least the fresher memory that Latin America has of higher inflation, obviously Latin American central bank started tightening much earlier than advanced economies central bank. And something, I mean, related to that is, I mean, maybe stronger informal indexing mechanisms in Latin America, basically associated to this memory of higher inflation and maybe at the margin, not at the margin, but lower credibility of central banks, or at least concerns of fiscal dominance. And I think these were larger in the case of Brazil, that at one point, that at least its central bank was not fully independent. But I think given the high levels of debt in Brazil, et cetera, people were also concerned about a situation in which part of the solution out of high debt in Brazil would imply higher inflation that will erode the debt, et cetera. And I think there the central banks needed to show that they were willing to increase rates maybe more than what was expected, just to signal that degree of independence. So I would say in that, let's say, taxonomy, you have Brazil and Chile having aggregate demand, credibility issues, et cetera, on top. Not in Chile. I mean, in Chile, let's say only aggregate demand. In Brazil, a little bit less on the aggregate demand, but more on the fiscal dominance, credibility, et cetera. But countries that needed to tighten in addition to the aggregate supply shock, to the supply shock coming from mainly from outside. Then Colombia is getting closer to this situation if, I mean, growth in 2022 ends up being around 6%. And then Peru and Mexico a little bit behind. And Mexico, basically, I mean, the only country that has not reached 2019 GDP levels. I would say that the country where the leading factor generating inflation should be imported inflation, although some local wage dynamics are taking place on the back maybe of the increase in the minimum wage, et cetera, that the central bank is concerned about. I mean, obviously, elections are generating or are another source of uncertainty now in Colombia this Sunday, moving towards, regardless of who wins the election, first on the risk. Colombia being a country that let's say lost investment grade last year, has a very challenging fiscal situation going forward, with two candidates in which their commitment to medium-term debt sustainability is questionable. So I think there the market will be reading into what the elected president will be saying the next few months with a magnifying glass to try to understand if the next government will need a market surprise to redesign its fiscal policy, will have to be called to reality by the markets, or they're going to come out with a fiscal policy that tries to accomplish some of the electoral promises, but within a fiscal framework that from a medium-term perspective makes sense. From a long-run perspective, I think there's a positive elements in the current, let's say, accommodations of the geopolitical puzzle pieces for Latin America. No? In a way, Latin America seems to be a region that lies outside geopolitical tensions today. So within this first year of the Biden administration, it became clear that the pivot of US policy towards China, it's a permanent phenomenon. So it comes within different packaging styles, but the substance, it's that, I mean, in terms of development, China has crossed the threshold between being the largest country in the world in terms of population that needed to be brought into the global community to being seen as a geopolitical challenger, and therefore needed to be treated as an antagonistic country in terms of its relationship vis-a-vis the international community. No? And I think that's where we are now. And that obviously Latin America trying to establish and navigate through that narrow path in which we should have constructive relationships between the US and Europe, but also constructive relationships with China and Asia, can become a continent that takes advantage of this situation. I mean, obviously, the high commodity prices are good on average for Latin America. I mean, the problem is that the distribution of this positive average effect for Latin America, it's super uneven between countries, and it's also very uneven between producers and consumers. I mean, even in countries that are exporters of commodities, and on aggregate are having a positive income shock. That positive income shock is concentrated on the producers of commodities, but consumers are facing a significant increase in prices. And therefore, we are seeing reductions in tariffs, government support programs, and some, let's call them, price management in energy, especially to contain this income effect. But obviously, the distribution between countries, especially when you look at Central America and the Caribbean, very negative energy shock, and the commodity producers, but then between economic agents, basically consumers having a very important negative shock that has to be dealt with by governments, but at least on aggregate, it's a positive shock, and through policy you can manage this to be a positive things. And also the change in the conceptual change on how advanced economies will be looking at the commodities market, not as an integrated market in which you're only concerned about price, but also about a country in which you want to secure supply. And there again, Latin America has an advantage in terms, again, of being pretty open to dealing with everybody and taking advantage of this situation to have a constructive but economically more profitable relationship in terms of guaranteeing supply of different commodities to different countries in the world. And on the negative side, being a net debtor region with let's say, structural current account deficit, we should be facing negative effects from the increase in interest rates and the important volatility and potential medium-term withdrawal of capital flows to Latin America. So far, I would say Latin America has not been able to put together a strategy that will allow it to really reap the full benefits of this international conjunction. I mean, in a way, although these summits, let's say these diplomatic summits, are always more a show, and it can be a show of goodwill or badwill, etc. But at the end of the day, I think this, what we saw in Los Angeles was a region that really cannot get their act together on how they want to act collectively to reap some advantages of this environment. So given that, you kind of go back to your very comfortable and maybe defensive position of using these fora more for domestic purposes and grandstanding than really trying to take advantage of maybe putting aside the differences between the Latin American countries and seeing which are the three things in which we want to focus vis-a-vis the US, Canada, and other countries in the world, and how can we work constructively to get those things done. And that, I think, we did not see during the pandemic. We didn't see Latin American countries getting together and having a very forceful position vis-a-vis international organizations, etc., advanced economies, and we're not seeing it now either. And then given the domestic policy uncertainty, the lack of a very clear policy out of these four gaps, economic, fiscal, monetary, and social, and fifth, let's say, polarized politics, and uncertain macro and micro policy frameworks, it generates an environment in which, yeah, I mean, Latin America is not being able to generate the trust so that a very strong effect from, let's say, this nearshoring, etc., can take effect. On that, I think also, I mean, some institutions, some people, I think this nearshoring effect that has moved from nearshoring to friendshoring to maybe family shoring, no? Now we're going to call it. Basically, first, it has an element in which, given the pandemic, we realize that we need to have a more diversified production footprint, because we don't want to have nodes in our production network that become critical. So we want to have redundancies in our production network. That's one. Secondly, potential interruptions on the global value chains due to problems in transportation are real, and therefore closeness is not only an issue that can be measured in hours of transportation, eventually can become days, months, weeks, etc., and there being geographically close is valuable. Then we move to the friendshoring, that it's not an issue, I would say, of enemies and friends and blah, blah, but it's an issue of if we suffer a shock, with which countries can we work towards quickly adapting our policies so we can make our global value chains continue to work effectively through the negative shock. And obviously, then you work with those economies and those countries with which you feel there's strong affinity to work together through shocks. Obviously, at the extreme, you don't want to work with a country in which actually policies will be implemented with a geopolitical objective instead of an economic objective. So all of those things, I think, point towards a good thing for Latin America. I think there's scope for a strong push of FDI and local investment to take advantage of this. But I think when we look at the potential orders of magnitude of this, I mean, this is not a silver bullet. I mean, some people are talking about an increase, let's say, of, I don't know, $50 billion of exports from the region. If you put on the table $50 billion, and you say how much of that is domestic value added, let's say half, then you have 25 billion. 25 billion is what, maybe 0.4% of GDP. If you have a multiplier of 2 or 2.5, then you have your new steady state equilibrium path, it's 1% higher, 2% higher. If this takes place within 5 years, that gives you maybe 40 basis points of additional growth. I mean, you can make the numbers up, but I think people have not, and look, have a percentage point of Latin America GDP, it's a lot of money, and it's very important, but will not change the growth dynamics of Latin America unless we use this together with a change in domestic policies that we change it from working with the solo model to going to the roamer model. No, so if we go from a level effect to a growth rate effect, then obviously all the quantities are completely different, because if this export shock allows us to grow 20 basis points at a higher growth rate of 20 basis points per year, then in net present value becomes relevant. No, but that's what we are not seeing. Countries are, my country in Mexico, I mean, we're generating huge uncertainty regarding the potential supply of electricity. So who on the manufacturing sector will want to go to a country to make an investment for the next 10 years where you do not know if you're going to have a guaranteed electricity supply or not? And I think in different countries, we're seeing this. In the case of Chile, although they went, I think, through a very nice institutional route that hopefully, in the good scenario, will be able to square the circle between a more socially just country, but maintaining the market dynamics that made Chile the country with a sustainable high rate of growth in Latin America. Still, it's a lot of uncertainty. You have a redrafting of the constitution, then you will have a redrafting of your local legislation, and then you have a pretty left-wing constitutional assembly, a right-wing Senate, and a center-left or a president that is from the left but wants to govern as a center-left president. Well, how this whole thing is going to work out, I think is generating a lot of uncertainty. In Peru, I mean, you already started discussion regarding impeaching the president. It has not moved forward, but I mean, this is the first year of a president that you're there. So, I mean, obviously the uncertainty is very. So just to close, I would say on short-term growth, I think we as economists have to look deeper into how we measure scaring and the potential maybe for a larger rebound. If scaring is a little bit smaller than what we had assessed, maybe in the short term, I mean, with the volatility in markets, inflation, etc., that will not be fully captured now, but maybe there's some rebound still left in Latin America on average that will materialize in the next 3 or 4 years. Secondly, inflation and monetary policy. I think, I mean, there might be some countries that are overdoing it. For example, when you look at Mexico, I think you have the largest difference between policy rates in Mexico and the US that we have seen in the last 7-10 years. On the other hand, the position of the business cycle might be also at an extreme, with the US with a significantly overheated economy, and Mexico not even getting back to 2019 levels. So from the cyclical perspective, we should have a relatively small difference vis-a-vis interest rates in the US instead of having the largest difference between the Mexican rate and the US rate. I think we a conversation that it's not done explicitly in Mexico, in many Latin American countries, and I think some central banks through boxes have not been fully clear. I mean, no central bank wants to be fully transparent on this, but I think the discussion should be deeper, is a discussion on the neutral rate. I think even before, let's say, the inflationary shock, in many Latin American countries, we haven't heard a good discussion for why the significant decline or perceived decline in neutral rates in the advanced economy should not be feeding through emerging markets or Latin American economies. So I think that this concept of which is the terminal rate, which is the neutral rate, etc. I mean, to anchor a little bit the tightening monetary policy cycle, and eventually where we're going to overshoot this neutral rate, then we're going to go back. And to explain this whole cycle, I think we need to explain the endpoint, and we have to have a better discussion on debt and the possibility of debt crises. Obviously, this combination of factors will eventually and might generate to a larger mass of emerging markets having debt issues in the next 5 years. Some of them can be from Latin America, but I think, I mean, sometimes the profession will run into quickly into these discussions of calling Lee Buchheit and all the other international lawyers that have been in sovereign debt discussions under New York law. But I think, I mean, if we have debt problems, many of them would be in local debt, given the huge development of local markets. And on top of that, that this macroeconomic framework is generating a significant uncertainty regarding the real exchange rate, short-term exchange rate movement. So in a way, maybe a lot of foreign investors will not want to live through the FX uncertainty that this will generate. And therefore, the pullout from domestic debt will be more important. In shorter term, the bunching of their amortizations is much larger than in foreign. So I think the issue of how a local debt crisis will materialize is one we have to focus a little bit more. And then I would say the last one is, well, the question, if we go through a recession in the US, will Latin America have a recession or not? I think it's not a done deal. I think, I mean, given a lot of Latin American countries being much more tightly linked to the commodity cycle, will also depend on what happens to commodities. But obviously, the pull that the US will have in the world economy, together with, especially if we go through a period of stagflation in the US with very high interest rates affecting Latin America, I think we will see risks of a recessionary environment in Latin America on the back of the US, and especially on the tightening of monetary policy in the US. And I will close these initial remarks with that, Aida.
Thanks so much, Alejandro, for this really rich view on the region that not only looked at the short term, but also even looked behind at 2020 and 2021, and then put forward some challenges in the long term, but then also left us a number of interesting questions to look at from our perspective of advising policymakers. So you have really covered a lot of ground, and I have very much enjoyed. I will just maybe share 3 thoughts, and then I will add 1 question while our viewers get the time to post questions on the chat. And the first one is, the U.S. recession. You ended with that, but also you started with it. I think is it's top of the headlines and top of the discussions among many people, especially in the U.S. And maybe just to share our view in the OECD. We released our forecast last week, our economic outlook, a bit like the wheel, and there actually, I guess that we are on the more optimistic side because we don't really forecast a recession for the U.S. Of course, we forecast a significant slowdown over the next 2 years, but we see that the Fed walking, through this fine line and managing to cool down demand, without triggering a recession. At the same time, we do recognize that there are many risks. First from much tighter monetary policy because it got a bit out of hand, but also because of all the external factors like higher commodity prices and the many other issues that globally we are seeing. Then my second point is on Latin America. I think we are on the same page regarding the growth profile for the two next years. I think we have 2% growth for 2022 for the 6 largest economies and 1.6 next year. I thought it was very interesting your point about underestimating the recovery and perhaps those pockets of growth that may show up and the need to measure scaling. I think on our side we have been looking at the recovery in the labor market with a bit less optimistic eyes than what you described. I think that what we've been saying is that participation has fallen in several countries, and also that informality that typically worked as a buffer in previous shocks, this time didn't happen. So even if labor markets recover, there's still some recovery there to be done. But I agree that this is something that we need to look at it in detail. About the long term, I really like how you picture the positive upsides for Latin America in terms of geopolitics, and this is something that we have also been emphasizing, the possibility for Latin America to benefit from basically greater trade because of these outcomes that we are seeing. But we do think that for that to happen, they need to be domestic reforms. Like you were mentioning the fact of lower competition in some sectors, there are also barriers to entry for foreign firms. So this needs to be tackled. Many countries are not very well integrated into global value chains. So it's not a given. I mean, there's quite a bit of work to be done before Latin America benefits from this greater integration and nearshoring and all that. And then I'll just conclude with my question, which is on the fiscal side, because you pointed out that yes, countries have come out with higher debt. There's probably pressures that are going to build up in terms of fiscal needs. We have what the pandemic left in terms of needs, because poverty and inequality is higher, but also we have the current high commodity like food and energy prices, and maybe governments in this situation in which they are in, they will be pushed to delay consolidation and even to step on the giving money accelerator. So in that context, and reflecting on your last point about debt crisis with a more of a domestic component. So how do you see that trade-off between fiscal consolidation, investment needs, and the current situation where there is still a lot of social needs? I know this is a very broad question, but it's basically your view about fiscal policy and how ideally that would happen. So that's one question I have, and then I'll pick from the chat. Thanks.
No, thanks. Thanks for your comments and your last question. Look, I think let's call it the slow and incomplete recovery from COVID, and on top of that, the negative shock coming from the energy and food crisis will combine with the lack of political cohesion to make gradualism the only viable path, or almost viable fiscal path towards consolidation. Obviously, consolidation should rely on an important dimension with a reduction of expenditures, because these were extraordinary expansion. And then we can discuss whether we need additional social insurance funded from a medium-term perspective with a tax reform. But from a cyclical, at least, point of view, you're not able to put like a grand bargain on the table when you deal with the long-term and the short-term and blah, blah, blah. I would say the combination of the slow growth. I mean, if Latin America grows at the numbers that you're putting on the table, 2 and 1.5 next year, and even it can be lower than that, together with the need to support families through the real support really needed, 40% of the population in terms of foodstuff support. And then politically, you need to support people on the energy side, because if not, they come out on the streets. That maybe as an optimal design, you will say these are segments of society, depending on how large the increase in their energy bill is, that should be dealing with the increase by themselves, given the type of country that we are and the cost-benefit analysis of assigning public resources. But if those are the sectors of society that can potentially mobilize politically, then you have a problem there that you have to address as well. And we have created, we as societies, these this perception in politicians that if you touch energy prices, you have people, and gasoline prices, you have people on the street tomorrow. You have the transportation sector, etc. So if you're a weak government, touching energy prices, it's a bold or suicidal maneuver. No? So as you say, I mean, yeah, I would say fiscal consolidation will come gradually. It might end up coming a little bit more biased toward more taxes than expenditures that maybe in some countries will not be the best combination, especially how the expenditures are. I mean, just increasing taxes to sustain a larger amount of energy subsidies doesn't seem to be the right policy, but maybe that will be the combination. And then Latin American countries have significant buffers still to manage potential problems, funding problems with markets. You have a relatively large amount of international reserves. You have a relatively good debt structure in terms of duration and maturity. You have local investors, local institutional investors that are holding a significant amount of foreign assets that can be transformed into local assets as well. So I don't envision in the next 12 months having that. There might be a lot of volatility, etc., but you have a lot of instruments with which to work. But those buffers start being eroded if you use them, and then you might have a situation in which you use them at the beginning of your government, and then at the end of your government, you don't have the political capital to do the reforms, and you no longer have the buffers, and then maybe if interest rates in the US continue to be high, then you face a problem. So I'm not talking about imminent problems, but maybe we'll start seeing the erosion of buffers in Latin America, and that will put Latin America, especially the large countries, in a more vulnerable position going forward. So, but definitely, I think I do not see the political scope for a grand bargain, and I do see that the politics are such, and the economics. I mean, I think the optimal design is of a gradual consolidation. The problem is that vis-a-vis the markets, maybe it's better to do it faster, so that financial conditions don't deteriorate as much, given the lack of confidence in this medium-term consolidation. No? So even you announce a gradual consolidation, markets know that there might be a timing consistency problem, and therefore they don't believe you, and then the positive effects of the consolidation on funding terms that don't materialize, and therefore you have to do it faster. But politically, you cannot do it faster. I think that's the conundrum. If I were here 18 months ago working for the IMF, I wouldn't say that the US is going to go into a recession. But I think, look, it's so complicated, and you have so many forces on the inflationary front, and the Fed has been called, and I think has been so far behind the curve that now, I mean, at the end of the day, eventually they will move to a point in which it will be better for them to err on the side of being more bold, and I think at the end of the day that will happen. And yeah, the labor market in Latin America is not something that I'm an expert and I have not followed that closely, but I think we have to look deeper into that, and we also have to look deeper into the destruction and creation of firms to see exactly what did we lose, what are we creating, and what is the scope of this new creation of firms continue up until one point, and then what are the labor capital matches that form there, and exactly what are the aggregate macro growth implications of that new landscape of the segment of the firm where we have destruction and new formation, no? And where the margin of new growth will be coming from, maybe from old firms, etc. So understanding that a little bit more. I mean, maybe in other crises, people are used to write these models where they say the cleansing effect of recessions. Did we clean something, and then factors will be moving to more productive uses? So I think we need to look at which of these theories will be playing out in a better way. I think from a longer term perspective, the number of schooling weeks that we lost, and the permanent effects that we might have on school attendance of those kids that didn't get a good education, didn't go to school, and only watch it through TV in some countries, and will not be going back to the classroom. I think that could be an important effect 10 years from now.
Thanks so much for those answers. They've been really, really clear, and your views on that they were really reassuring as well. So thanks a lot. There are a couple of questions on our chat, and we still have 10 minutes, so hopefully we will be able to cover them. One of them is a bit tricky. The first one, I would say, and I think you have partially answered, but so the question is, how do you see the political economy of making reforms happen in Latin America in face of the increasing fragmentation that you were describing in terms of elections coming up, but also the one that we see in Congress, many congresses in the region right now. So that's one question. If you want to pick it up, shall I say both questions?
Yeah.
Okay. And then the second question, which is related to discussion on stress in debt markets, and whether this could first appear in domestic debt markets. The question is, would you expect more outright forms of debt repayment and restructuring problems, or central banks throwing the towel to allow for inflation to tame those effects?
I haven't seen any evidence and any move, neither coming from society at large or from governments, trying to undermine central banks to be less aggressive, and therefore to open the door of thinking that this scenario of inflating away the debt is something that might happen. I think societies and governments actually know that look, we cannot go through Congress to fix a fiscal. We cannot generate some agreement in society to do a big social security reform that is funded and that will create. We cannot open up the economy but what do we have? We have stability, the financial system that is healthy, and we have a debt market that is working. Let's not play with that. I think, I mean, we know about the cost of high inflation, but it's kind of, what do you have? We have stability, okay? I don't know on growth, on social issues, but maybe we cannot do much, but let's not lose this. And I think governments recognize this, society recognizes that. So I don't think, I do think I will go through the first part of this policy choice that the person is asking. Maybe we will see either financial repression, either de facto or de jure. Well, de jure would be through capital flow management measures, capital controls, etc., or de facto basic. It's de jure on the fact. A milder way will be by changing the regulation of insurance companies and pension funds so that they buy more domestic assets instead of foreign assets. So that will force them to buy the debt, and that will put some downward pressure of interest rates, and then help on the liquidity side and on the sustainability by reducing interest rates, or outright restructuring of local debt. That it's easier to do because you can change the legislation, and that, I mean, I'm not saying that it's the best way to do, but I think legally it's much easier than getting into a restructuring of foreign debt. So yeah, I will put inflating away debt with a lower probability in many of these countries, and I will think that if eventually buffers are eroded, etc., with some kind of hidden shadow debt restructuring through financial repression or outright local debt restructuring might happen in some of, if a country facing this situation. On how to, look, I think it's very hard to think how to build this political consensus, and I think we are not there. I think in some countries, people, look, for example, if you look at you look at Chile, I think in a way, President Boric is trying to do that. I mean, he very quickly after the election, he moved a little bit more to the center, maybe generating some fractions within his coalition, but trying to position himself both trying to be honest to his electoral platform, but also recognizing where the median Chilean voter is, and recognizing that both from a pragmatic and practical way, the only way to govern the country is to try to govern for the whole population, and also from a pragmatic and political way, saying, I mean, the distribution of political power is such that if I don't move to the center, I will not be able to govern. So I have two choices, either to go through the route of becoming more autocratic and undermining institutions, or accepting the institutions, thinking that this is good for the medium term of our country, and then trying to work through these institutions, positioning myself and the country agenda somewhere in between where I would like it to be and where the median voter is, and trying to generate consensus there, no? The opposition or the other blocks. Or we see the route of people saying, look, I mean, the country is not where my agenda is. I will try to undermine the institutions that limit my capacity to implement my agenda, but I will implement my agenda. And I think we're seeing those models also develop in Latin America, and I think it's pretty risky, no?
Thanks so much also for that, for those specific examples that allow us to picture the ideas in our mind. I don't see any other question on the chat, so that leaves us with thanking you very much for this great discussion